And now for our segment, 5 minutes on the market. Is it going to be March Madness in the market, or are we going to see new all-time highs? Let's dig into it. S&P year to date up 7%, the Dow up 3, Russell up 1, emerging markets up 1.5, and bonds are down 1%. If we look at where the top 20 analysts on Wall Street, where they think the market is headed, the biggest bull thinks the market's going to be up 14% at the end of the year. The biggest bear thinks the market will be down 12%. Some of these analysts have had to revise those projections as the market has had a really strong first couple months in the year. Now, where do we think the market is headed, and where are we going from here? Well, 85% of the indicators that we track are positive. Just 15% are negative. So I think that's a good sign. What are the top items that we're focused on? Well, the Fed has let us know that they're probably not in a huge hurry to cut interest rates. With how strong the market, how strong the economy is, they're making it clear that they're likely going to hold and probably be cutting rates second half of the year. Something we've talked about before, but I think is still critically important. When the Fed cuts interest rates in a recession, it's a bad sign. But if you're not in a recession, which is where we are now, it's typically very positive for the market a year later. I think inflation continues to be a big driver. If inflation can stay muted, the market will have potential to continue to rally. If it comes back, there'll be more challenges ahead. Some very important statistics. The market has reached a new all-time high in the S&P. It's taken a couple years to do that. And historically, over the past 75 years, when the market's taken a year or more to reach a new all-time high, it's been a big positive. The market's marched higher 13 of 14 times, on average 15%. Is investing at an all-time high the wrong time to invest? I don't think so. If you look at this recent report, the 1-year performance of the market when the market reaches a new all-time high, you're looking at about 10% per year versus if it's not an all-time high, being over 11% per year. So still very positive sign for the market and not a reason to be cautious about investing. Now, with the market up in January and February, 2 positive months in a row to start the year. Since 1950, a year later, the market's been higher 27 out of 28 times, on average 14.8%. We've seen some good flows into the stock market, flows coming from people's cash, some FOMO, some fear of missing out, people adding more money to the equity markets. I think that's a really good sign. The top news items we're keeping an eye on is recession. The fear of that really has evaporated. We look at the Federal Reserve, the odds of them cutting interest rates by May has declined significantly. It was above 80%. Now it's very, very low. So the number of rate cuts expected has come down. International conflict is still something to keep our eyes on, whether it's Ukraine, Russia, with what's going on in Israel. It has not really had a big impact on the markets and the economy. Most relevant market commentary is with such a big jump higher in the markets to start the year, even the biggest bulls are getting a little bit wary. Like, hey, are we over our skis here? Do we need to slow down a little bit? So some type of correction is absolutely normal, happens every single year, and it would be expected with the run-up that we've had for the first couple months. Many are concerned about AI. Are we in an AI bubble? It's possible. We'll keep an eye on it. And it's important to know that the run-up that we've seen in the S&P 500, if we look at some of the charts, the last 15 weeks, the S&P has been positive. That's the best streak since 1972. Would it be likely that there could be a breather in the market? Absolutely. Most relevant market data that we're watching, GDP growth has still been strong, has still been good. Earnings projections are good. They're strong. Profitability for companies has been quality. And small caps, we still think there's some very good opportunity. There's been a real divergence, large cap versus small cap. We think small cap likely has a good year this year. I think also positive is a lot of the growth we've seen in the market has come from earnings. It hasn't just been multiple expansion. I think that's positive. And remember, keep a little perspective. You look at the past 3 years, the market's been really flat outside of tech and some of these tech companies. But kind of a tough few years for the market broadly. Something to keep in mind is PE ratios for the 8 largest companies pretty high, but the bottom 492 are within historic averages. Still a ton of cash on the sidelines. I think that's reasons why the market could get pushed higher as there's more FOMO out there. Our biggest commentary on the market, I do think there's more upside to this market. If you look historically, a correction of 3% or more happens on average 7 times per year. A correction of 5% happens 3 times per year, and a 10% correction on average happens every single year. So our biggest takeaway on the market, there is more upside, we think, in this market. An inter-year correction could be expected. I think small caps present a good opportunity. Buffered equities are definitely worth looking at, and some more active strategies, some more individual security selection, I think could be very valuable. And that's our 5 minutes on the market.